Hello everyone, and welcome. Today we're diving into a topic that's close to the heart of the American dream: mortgage rates. Understanding mortgage rates is crucial. These little numbers have a big impact. They dictate how much house you can afford. Think of mortgage rates as the gatekeepers to the housing market. When rates are low, the gates swing wide open. Lower monthly payments make homeownership attainable. But when rates rise, those gates start to close. This can price some potential buyers out of the market. The impact of mortgage rates extends far beyond individual homeowners. They have a ripple effect on the entire U.S. economy. A healthy housing market keeps construction crews busy and real estate agents closing deals. This economic activity translates into jobs and overall economic growth. On the flip side, when mortgage rates climb, these industries feel the pinch. Mortgage rates are much more than just numbers on a loan document. They're a key indicator of the health of the U.S. economy. In this video, we'll explore the historical context of mortgage rates and analyze expert predictions. To understand the current mortgage rate landscape, it's essential to look back at where we've been. For decades, a sub-3% mortgage rate was the stuff of dreams. Then came 2020, and the world as we knew it changed. The COVID-19 pandemic sent shockwaves through the global economy. The Federal Reserve slashed interest rates to near zero, sending mortgage rates to historic lows. Suddenly, the dream of a sub-3% mortgage rate became a reality. Homebuyers rushed to take advantage, flooding the market with applications. The housing market boomed, with bidding wars erupting and home values soaring. As the economy recovered, inflation prompted the Federal Reserve to raise rates, and mortgage rates climbed. The quest for homeownership is deeply embedded in the American psyche. It's the cornerstone of the American dream, a symbol of stability, security, and prosperity. Mortgage rates play a pivotal role in this dream. They determine the affordability of homeownership. When mortgage rates are low, the dream of owning a home becomes attainable for more people. However, when mortgage rates rise, the dream can feel out of reach. Families might have to settle for smaller homes or delay their plans. A home is more than just a roof. It's where memories are made and traditions are born. Understanding mortgage rates is crucial to realizing the American dream. Beyond the personal aspirations of homeownership, the mortgage market plays a crucial role in the overall health and vitality of the U.S. economy. It's a powerful engine that drives economic growth, creates jobs, and influences a wide range of industries. When mortgage rates are low and the housing market is active, it sets off a chain reaction of economic activity. Construction companies hire more workers to build new homes, fueling job growth and boosting the construction industry. Real estate agents see an increase in transactions, generating income and supporting the real estate sector. Furniture stores, appliance retailers, and home improvement companies all benefit from the surge in home buying and renovations. This ripple effect extends even further. As people purchase homes, they often take out home equity loans to finance renovations or consolidate debt, injecting more money into the economy. The increased demand for goods and services associated with homeownership stimulates economic activity across various sectors, contributing to overall economic growth. Conversely, when mortgage rates rise and the housing market cools down, the economic engine slows. Construction projects might be delayed or canceled, leading to job losses in the construction industry. Real estate agents face a decline in business, and the ripple effect impacts related sectors like home staging and moving services. The health of the mortgage market is a key indicator of the overall health of the U.S. economy. Policymakers and economists closely monitor mortgage rates and housing market trends to gauge consumer confidence, assess economic growth, and make informed decisions about monetary policy. Section 5. A complex equation: factors influencing mortgage rates. Understanding how mortgage rates are determined is like unraveling a complex equation with multiple variables. A multitude of factors, both domestic and global, influence the cost of borrowing money for a home, creating a dynamic and ever-changing landscape. One of the most significant drivers of mortgage rates is the Federal Reserve, the central bank of the United States. The Fed doesn't set mortgage rates directly, but its monetary policies have a ripple effect that influences the cost of borrowing for consumers. When the Fed wants to stimulate the economy, it might lower the federal funds rate. the interest rate at which banks lend money to each other overnight. This tends to lower interest rates across the board, including mortgage rates, making it cheaper to borrow money and encouraging economic activity. Conversely, when the Fed wants to combat inflation, it might raise the federal funds rate, which can lead to higher interest rates on loans, including mortgages. This can slow down borrowing and spending, theoretically cooling down the economy and curbing inflation. In addition to the Fed's actions, other economic indicators play a role in shaping mortgage rates. Inflation, for example, erodes the purchasing power of money, making lenders demand higher interest rates to compensate for the risk of inflation eroding the value of their loans. Employment data is another important factor. A strong job market with low unemployment typically signals a healthy economy, giving lenders confidence to offer lower mortgage rates. On the other hand, high unemployment and a weak job market can make lenders more cautious, potentially leading to higher rates. Section 1. The current landscape, navigating the shifting terrain. As we delve into the current mortgage rate environment, it's clear that we're in a period of significant transition. After the historic lows of 2020 and early 2021, mortgage rates have been on an upward trajectory, reflecting a confluence of economic factors that are reshaping the borrowing landscape. For many who enjoyed the ultra-low rates of the recent past, this upward trend might feel like a cold splash of reality. The era of sub-3% mortgage rates, while fleeting, created a sense of affordability that's now being challenged. But it's important to remember that mortgage rates, like any financial indicator, are cyclical. They ebb and flow in response to economic conditions, policy decisions, and market sentiment. The current upward trend in mortgage rates is not necessarily a cause for alarm, but it does require careful navigation and a clear understanding of the factors at play. By examining the forces that are driving rates higher, we can gain valuable insights into the potential direction of the market and make informed decisions about our own financial strategies. Whether you're a homeowner considering refinancing, a prospective buyer hoping to enter the market, or simply someone who wants to stay informed about the economy, understanding the current mortgage rate landscape is essential. Section 2. The inflation equation, unpacking the price surge. One of the most significant drivers of the recent surge in mortgage rates is the unwelcome guest that's been making headlines: inflation. This persistent rise in the general price level of goods and services has sent shockwaves through the economy, eroding consumer purchasing power and prompting swift action from the Federal Reserve. Inflation is a lender's worst nightmare. When prices rise, the value of money erodes, meaning that the money lenders receive back in the future is worth less than the money they lent out today. To compensate for this risk, lenders demand higher interest rates on loans, including mortgages. The current surge in inflation, fueled by a combination of supply chain disruptions, increased consumer demand, and government spending, has forced the Federal Reserve to take aggressive measures to rein in rising prices. The Fed's primary tool for combating inflation is raising interest rates, which makes borrowing more expensive and theoretically slows down economic activity. As the Fed continues its campaign to tame inflation, mortgage rates are likely to feel the upward pressure. The question on everyone's mind is, how high will rates go, and how long will it take to bring inflation under control? The answers to these questions will depend on a complex interplay of economic factors and policy decisions, making it difficult to predict the future with certainty. Section 3. The Fed's balancing act, steering between growth and inflation. At the heart of the mortgage rate equation lies the Federal Reserve, the central bank of the United States. The Fed balances promoting economic growth with controlling inflation. The primary lever is the federal funds rate, influencing borrowing costs, including mortgage rates. Lowering rates stimulates economic activity, making homeownership more affordable. However, raising rates can curb inflation but may stifle growth. This balancing act makes the Fed's job challenging and decisions closely watched. The Fed's recent pivot towards tighter monetary policy signals a shift in priorities. With inflation high, the Fed focuses on controlling prices, affecting mortgage rates. Section 4. The global stage, international factors at play. While the U.S. economy often takes center stage, mortgage rates are not immune to the forces at play on the global stage. International events, economic conditions in other countries, and global investment flows can all influence the cost of borrowing money in the USA, adding another layer of complexity to the mortgage rate equation. One way in which global factors impact mortgage rates is through the bond market. When investors perceive economic or geopolitical risks abroad, they often seek safe havens for their money, such as U.S. Treasury bonds. This increased demand for U.S. bonds can drive up their prices, which in turn pushes down their yields. Since mortgage rates tend to track the yields on 10-year Treasury bonds, a decline in bond yields can lead to lower mortgage rates, even if the Federal Reserve is not actively cutting interest rates. Conversely, when global economic conditions improve or geopolitical risks subside, investors may shift their money out of U.S. bonds and into riskier assets, which can push bond yields higher and put upward pressure on mortgage rates. The interconnectedness of the global economy means that events happening thousands of miles away can have a ripple effect that's felt in the U.S. housing market. From trade wars and currency fluctuations to political instability and natural disasters, a wide range of global factors can influence mortgage rates, making it essential to stay informed about international developments and their potential impact on the U.S. economy. Section 5. Supply and demand. The housing market's push and pull. Zooming in from the macro level to the micro, the dynamics of supply and demand within the housing market itself play a crucial role in shaping mortgage rates. When the demand for homes outstrips the supply, it creates upward pressure on prices, making it more expensive to borrow money to buy a home. The recent surge in housing demand, fueled by a combination of low mortgage rates, changing lifestyle preferences, and a growing population, has put a strain on housing supply in many parts of the country. This imbalance between supply and demand has contributed to rising home prices and, consequently, higher mortgage rates. When home prices rise rapidly, lenders perceive a higher risk of default, as borrowers may struggle to keep up with larger loan payments. To mitigate this risk, lenders may increase mortgage rates, further exacerbating the affordability challenges faced by prospective homebuyers. On the supply side, factors like construction costs, land availability, and zoning regulations can all influence the pace of new home building. When construction costs rise due to supply chain disruptions or labor shortages, it can slow down the pace of new construction, further limiting the supply of homes and putting upward pressure on prices. The interplay between housing supply and demand is a constantly evolving dynamic that can have a significant impact on mortgage rates. Understanding these forces can help both homebuyers and sellers navigate the market effectively and make informed decisions about their real estate strategies. Decoding the economic signals. What to watch for. Navigating the world of mortgage rates can feel like deciphering a secret code. But fear not, savvy consumers. By learning to read the economic tea leaves, you can gain valuable insights into the factors that influence mortgage rates and make more informed decisions about your financial future. Think of economic indicators as puzzle pieces. Each one provides a glimpse into a different aspect of the economy, and when assembled, they paint a broader picture of where the market might be heading. By keeping a close eye on key indicators, you can anticipate potential shifts in mortgage rates and position yourself accordingly. Some of the most important indicators to watch include inflation data, employment reports, and housing market statistics. Inflation, as we've discussed, erodes the value of money and can push mortgage rates higher. The employment picture reflects the overall health of the economy, with a strong job market typically supporting lower mortgage rates. And housing market data, such as new construction starts and existing home sales, provide insights into the balance of supply and demand, which can influence mortgage rate trends. By staying informed about these key economic indicators, you can become a more astute observer of the mortgage rate landscape and make more confident decisions about your financial future. The Fed's crystal ball interpreting policy statements. The Federal Reserve, often shrouded in an aura of mystique, holds significant sway over the direction of mortgage rates. While the Fed doesn't set mortgage rates directly, its policy decisions and pronouncements send ripples through the financial markets, influencing the cost of borrowing for consumers and businesses alike. One of the most anticipated events in the financial world is the release of the Federal Open Market Committee (FOMC) statement following its monetary policy meetings. These statements, carefully crafted by the Fed's top officials, provide insights into the central bank's assessment of the economy and its outlook for future interest rate moves. Investors and analysts hang on every word of these statements, parsing them for clues about the Fed's intentions and their potential impact on mortgage rates. A hawkish tone, suggesting concerns about inflation and a willingness to raise interest rates aggressively, can send mortgage rates climbing. Conversely, a dovish stance, emphasizing the need to support economic growth and signaling a more patient approach to rate hikes, can provide a sense of relief for borrowers. Learning to decipher the Fed's language and interpret its policy statements can give you a leg up in understanding the forces that shape mortgage rates. By paying attention to the Fed's pronouncements and the market's reaction to them, you can gain valuable insights into the future direction of borrowing costs. Inflation expectations. Peering into the price pipeline. Inflation, that persistent rise in the general price level, is a key driver of mortgage rates. But it's not just current inflation that matters. It's also the market's expectations for future inflation. When investors anticipate higher inflation down the road, they demand higher interest rates today to compensate for the eroding value of their money over time. Think of it like this. If you lend someone money today with the expectation that prices will be significantly higher in a few years, you'll want to charge a higher interest rate to ensure that the money you receive back in the future has the same purchasing power as the money you lent out today. Several indicators can provide insights into inflation expectations, such as the Consumer Price Index, CPI, the Producer Price Index, PPI, and surveys of consumer and business sentiment. The CPI measures changes in the prices paid by urban consumers for a basket of goods and services, while the PPI tracks wholesale price changes. Surveys can gauge consumers' and businesses' expectations for future price increases. By monitoring these indicators and staying informed about the factors that are driving inflation expectations, you can gain a better understanding of the potential trajectory of mortgage rates. Remember, inflation expectations can be a self-fulfilling prophecy. If businesses and consumers expect prices to rise, they may adjust their behavior accordingly, leading to higher prices and potentially pushing mortgage rates higher as well. Section 4. Employment trends. Gauging the strength of the job market. The employment picture is a crucial piece of the economic puzzle that influences mortgage rates. A robust job market, characterized by strong job growth and low unemployment, typically signals a healthy economy and can support lower mortgage rates. Conversely, a weak job market with sluggish job growth and high unemployment can raise concerns about economic growth and potentially lead to higher mortgage rates. When employers are confident about the economy, they're more likely to hire workers, expand their businesses, and invest in new projects. This increased economic activity can lead to higher consumer spending, which further fuels economic growth and can keep inflation in check. A strong job market also benefits the housing market, as employed individuals are more likely to qualify for mortgages and purchase homes. Several key indicators provide insights into the health of the job market, including the monthly employment report released by the Bureau of Labor Statistics. This report provides data on non-farm payroll employment, the unemployment rate, and average hourly earnings. Other indicators, such as jobless claims, which track the number of people filing for unemployment benefits, and the labor force participation rate, which measures the percentage of the working-age population that is employed or actively seeking employment, can also provide valuable insights into the state of the job market. By keeping a close eye on employment trends and understanding their implications for mortgage rates, you can make more informed financial decisions. A strong job market can create a favorable environment for borrowers, potentially leading to lower mortgage rates and making homeownership more affordable. Section 5. Housing starts and permits, measuring the pulse of construction. Delving deeper into the housing market itself, housing starts and building permits offer valuable clues about the future trajectory of mortgage rates. These indicators provide a forward-looking glimpse into the pace of new home construction, which can influence the balance of housing supply and demand, a key factor affecting mortgage rates. Housing starts represent the number of new residential construction projects that have begun in a given period. When housing starts are on the rise, it suggests that builders are optimistic about future demand for homes and are ramping up construction to meet that demand. This increase in housing supply can help to moderate home price appreciation and potentially ease upward pressure on mortgage rates. Building permits, on the other hand, indicate the number of new residential construction projects that have been authorized but not yet started. They serve as a leading indicator of future housing starts, providing a glimpse into builders' expectations for demand in the coming months. An increase in building permits can signal that builders anticipate continued demand for new homes and are preparing to break ground on new projects. By monitoring housing starts and building permits, you can gain a better understanding of the dynamics at play within the housing market and their potential impact on mortgage rates. A surge in construction activity can signal a healthy housing market and potentially lead to more favorable borrowing conditions for homebuyers. Section 6. Inventory check. Assessing the balance of housing supply. The delicate dance between housing supply and demand exerts a powerful influence on mortgage rates. When the demand for homes outstrips the available supply, it creates upward pressure on home prices, making it more expensive to borrow money to buy a home and potentially leading to higher mortgage rates. One way to gauge the balance of supply and demand in the housing market is to track housing inventory levels. Inventory refers to the number of homes that are currently listed for sale in a particular market. A low inventory of homes for sale typically indicates a seller's market, where buyers may face competition for a limited number of properties, driving up prices and potentially pushing mortgage rates higher. Conversely, a high inventory of homes for sale typically signals a buyer's market, where buyers have more negotiating power and may be able to find better deals on homes. This can help to moderate home price appreciation and potentially ease upward pressure on mortgage rates. Several factors can influence housing inventory levels, including the pace of new construction, the number of homeowners choosing to sell their homes, and overall economic conditions. By keeping a close eye on inventory trends and understanding their implications for mortgage rates, you can make more informed decisions about your real estate plans. Section 7. Consumer confidence sentiments sway on the market. While economic indicators provide valuable data points, consumer confidence, that intangible but powerful force, also plays a role in shaping mortgage rates. When consumers are feeling optimistic about the economy, their jobs, and their personal finances, they're more likely to make major purchases, such as buying a home. This increased demand can fuel economic growth, support a healthy housing market, and potentially lead to lower mortgage rates. Conversely, when consumer confidence wanes, people tend to tighten their purse strings, delaying major purchases, and adopting a more cautious approach to spending. This decline in consumer spending can ripple through the economy, slowing down growth and potentially leading to higher mortgage rates as lenders become more risk-averse. Several indicators track consumer sentiment, including the Consumer Confidence Index and the University of Michigan's Consumer Sentiment Index. These surveys gauge consumers' perceptions of current economic conditions and their expectations for the future. A high reading on these indexes typically indicates optimism about the economy, while a low reading suggests pessimism. By monitoring consumer confidence indicators and understanding their potential impact on mortgage rates, you can gain a better understanding of the psychological factors that can influence the housing market. Remember, consumer sentiment can be a self-fulfilling prophecy. When people feel confident about the economy, they're more likely to spend and invest, which can further boost economic growth. Section 8. The Global Economic Symphony, harmonious or discordant? While the U.S. economy often takes center stage, Mortgage rates don't exist in a vacuum. They're influenced by a complex interplay of global economic forces, from growth rates in other countries to currency fluctuations and international trade flows. Think of the global economy as a symphony orchestra. When all the instruments are in tune and playing in harmony, it creates a beautiful and uplifting sound. But when one instrument is out of tune or a section is playing out of sync, it can throw off the entire performance. Similarly, when the global economy is firing on all cylinders, with synchronized growth across major economies, it can create a favorable environment for lower mortgage rates in the U.S. Strong global growth can boost demand for U.S. exports, increase corporate profits, and support a healthy job market, all of which can contribute to lower borrowing costs. However, when global growth is uneven, or when economic crises erupt in other parts of the world, it can create uncertainty and volatility in the financial markets, potentially leading to higher mortgage rates in the U.S. For example, a recession in Europe or a slowdown in China could reduce demand for U.S. goods and services, hurting U.S. economic growth, and potentially leading to higher borrowing costs. By staying informed about global economic developments and understanding their potential impact on the U.S. economy, you can gain a broader perspective on the factors that influence mortgage rates. Remember, the global economy is interconnected, and events happening thousands of miles away can have ripple effects that are felt in the U.S. housing market. Section 9. Geopolitical risks, navigating uncertainty's impact. In an increasingly interconnected world, geopolitical events can cast a long shadow over the global economy, including the U.S. housing market and mortgage rates. From trade wars and political instability to military conflicts and natural disasters, these events can create uncertainty and volatility, making investors nervous and potentially leading to higher borrowing costs. When geopolitical risks escalate, investors often seek safe havens for their money, such as U.S. Treasury bonds. This increased demand for U.S. bonds can drive up their prices, which in turn pushes down their yields. Since mortgage rates tend to track the yields on 10-year Treasury bonds, a decline in bond yields can lead to lower mortgage rates, even if the Federal Reserve is not actively cutting interest rates. However, this downward pressure on mortgage rates from geopolitical risks is not always a straightforward equation. While safe haven flows can initially push down bond yields, prolonged uncertainty and the potential for these events to escalate can eventually lead to higher borrowing costs. For example, if a trade war disrupts global supply chains and leads to higher prices for consumers, it can fuel inflation and force the Federal Reserve to raise interest rates more aggressively, ultimately pushing mortgage rates higher. Similarly, political instability or military conflict can create economic uncertainty, leading businesses to delay investments and consumers to pull back on spending, potentially slowing down economic growth and leading to higher borrowing costs. By staying informed about geopolitical developments and their potential impact on the U.S. economy, you can navigate these uncertain times more effectively and make more informed decisions about your financial future. As we've explored the myriad factors that influence mortgage rates, it's important to remember that these rates are cyclical. They ebb and flow in response to economic conditions, policy decisions, and market sentiment. Over the long term, mortgage rates have generally trended downwards. In the early 1980s, mortgage rates soared to double-digit levels, reaching a peak of over 18%. Since then, rates have gradually declined, reaching historic lows in recent years. This downward trend can be attributed to factors like declining inflation, technological advancements, and increased competition in the mortgage market. By understanding the cyclical nature of mortgage rates, you can avoid making rash decisions based on short-term fluctuations and instead focus on the long game. When it comes to predicting the future of mortgage rates, it's easy to get lost in a sea of conflicting opinions. Economists, financial advisors, real estate professionals, and market analysts all have their own perspectives. Some experts might point to historical trends and argue that mortgage rates are likely to remain relatively low over the long term. Others might focus on current economic conditions, such as rising inflation or a tight labor market, and predict that mortgage rates are headed higher in the near future. So, how do you make sense of all this conflicting information? The key is to avoid putting too much weight on any single prediction. Gather information from a variety of sources, consider different perspectives, and make decisions that are right for your individual circumstances and risk tolerance. Remember, experts can provide valuable insights, but they cannot predict the future with certainty. Economists, armed with their charts, graphs, and complex models, bring a data-driven perspective to the mortgage rate debate. They delve into the intricacies of economic data, analyzing trends in inflation, employment, economic growth, and other key indicators. One camp of economists might argue that the recent surge in inflation is transitory, driven by temporary factors such as supply chain disruptions and pent-up consumer demand. Another camp might take a more cautious view, arguing that inflation is more persistent and deeply embedded in the economy. This scenario could lead to a more significant rise in mortgage rates. The economy is a complex system, and predicting its future path is inherently uncertain. By understanding the economic data and the different perspectives of economists, you can gain a better understanding of the potential trajectory of mortgage rates. Financial advisors bring a holistic perspective to the mortgage rate discussion, considering your individual financial goals, risk tolerance, and time horizon. They can help you weigh the potential benefits of locking in a low mortgage rate today against the risks of waiting to see if rates might fall further. For example, if you're planning to buy a home soon and you're concerned about rising mortgage rates, a financial advisor might recommend locking in a rate sooner rather than later. On the other hand, if you're not in a rush and you're comfortable with a bit more risk, they might suggest waiting to see if rates dip. The key is to work with a financial advisor who understands your individual circumstances and can provide personalized advice. A good financial advisor will help you weigh the potential risks and rewards of different mortgage strategies and guide you towards a decision that aligns with your overall financial plan. Real estate agents and brokers, with their fingers on the pulse of the housing market, offer a unique perspective on the mortgage rate landscape. They witness firsthand the dynamics of supply and demand, observe trends in home prices and sales activity, and interact with buyers and sellers. In a hot housing market with low inventory and rising home prices, buyers might be more willing to accept higher mortgage rates to secure their dream homes. Conversely, in a cooler market with more inventory, buyers might be more price-sensitive and less willing to pay a premium. By paying attention to the observations and insights of real estate professionals, you can gain a better understanding of the local housing market dynamics. Remember, real estate is a local market, and conditions can vary significantly from one region to another. As you delve into the world of expert opinions on mortgage rates, one thing becomes clear: there's rarely a single unified consensus. Economists might debate the trajectory of inflation, financial advisors might offer varying risk assessments, and real estate professionals might observe different trends in their local markets. This lack of consensus can be both frustrating and enlightening. It highlights the inherent uncertainty of predicting the future, especially in a complex and ever-changing field like finance. By considering a range of perspectives, you can develop a more nuanced understanding of the potential risks and opportunities that lie ahead. Instead of searching for a single right answer, focus on understanding the different factors that could influence mortgage rates. The more informed you are, the better equipped you'll be to navigate the ever-changing world of mortgage rates and make decisions that are right for you. Inflation, that persistent rise in the general price level, has emerged as a central character in the mortgage rate saga. Some experts argue that the recent surge in inflation is transitory, fueled by temporary factors such as supply chain disruptions and government stimulus measures. Others express concern that inflation is more deeply entrenched in the economy, driven by factors such as a tight labor market and rising wages. The Federal Reserve's response to inflation is paramount. If the Fed believes that inflation is transitory, it might be more patient in raising interest rates, which could help to keep mortgage rates from rising too sharply. However, If the Fed views inflation as a more persistent threat, it might opt for more aggressive rate hikes, potentially leading to a more significant increase in mortgage rates. Understanding the inflation debate is crucial for anticipating the future direction of mortgage rates. The Federal Reserve holds significant sway over the direction of mortgage rates. While the Fed doesn't set mortgage rates directly, its monetary policy decisions, particularly changes to the federal funds rate, have a ripple effect throughout the financial system. Investors and analysts closely scrutinize the Fed's every word, parsing policy statements, meeting minutes, and speeches by Fed officials for clues about the central bank's intentions. A hawkish tone, suggesting concerns about inflation and a willingness to raise interest rates more aggressively, can send mortgage rates climbing. Conversely, a dovish stance, emphasizing the need to support economic growth, can provide a sense of relief for borrowers. The Fed's delicate balancing act between controlling inflation and supporting economic growth makes its policy decisions particularly challenging to predict. Factors such as the strength of the labor market, the trajectory of inflation, and global economic conditions all weigh heavily on the Fed's decision-making process. The U.S. economy, while a global powerhouse, doesn't exist in a vacuum. It's part of a complex and interconnected global system, where economic conditions in one part of the world can ripple outwards, influencing financial markets and interest rates far beyond their borders. Factors such as geopolitical events, commodity price fluctuations, and changes in monetary policy by other central banks can all create headwinds or tailwinds for the U.S. economy. For example, a slowdown in economic growth in China could have ripple effects throughout the world, potentially leading to lower demand for U.S. exports and slower economic growth in the U.S. Conversely, a surge in economic growth in Europe or Japan could boost global demand, leading to higher commodity prices and increased inflation. This scenario could put upward pressure on mortgage rates. The dynamics within the U.S. housing market play a crucial role in shaping the trajectory of mortgage rates. The interplay of supply and demand, affordability challenges, and evolving housing preferences all contribute to the complex equation that determines the cost of borrowing for a home. On the supply side, factors such as the availability of land, construction costs, labor shortages, and regulatory hurdles can constrain the pace of new home building. On the demand side, factors such as population growth, household formation, employment trends, and interest rates all influence the appetite for homeownership. Strong economic growth, a healthy job market, and low mortgage rates can fuel demand for housing, potentially leading to higher home prices and mortgage rates. Affordability challenges, driven by rising home prices and increasing interest rates, can also influence the trajectory of mortgage rates. As we've navigated the complexities of expert opinions, economic indicators, and housing market dynamics, one overarching theme emerges. The future of mortgage rates is inherently uncertain. While experts can provide valuable insights and analysis, no one has a crystal ball that can predict the future with absolute certainty. Instead of fixating on a single prediction or trying to time the market perfectly, it's more helpful to focus on understanding the range of possibilities and preparing for different scenarios. Consider your own financial situation, goals, and risk tolerance when making decisions about your mortgage. If you're comfortable with a bit more risk and you're not in a rush to buy a home, you might choose to wait and see if mortgage rates dip before locking in a rate. However, if you're more risk-averse and you're concerned about rising rates, you might opt to secure a mortgage sooner rather than later, even if it means paying a slightly higher rate. Section 1. Below 3% again? The million-dollar question? The million-dollar question that's on the minds of prospective home buyers and current homeowners alike. Will we ever see those tantalizingly low mortgage rates below 3% again? It's a question that sparks both hope and skepticism, fueled by a mix of historical memories, current economic realities, and a dash of wishful thinking. The allure of sub-3% mortgage rates is undeniable. Those record low rates, A fleeting gift from the turbulent early days of the pandemic fueled a surge in home buying and refinancing, making homeownership more attainable for many and putting extra cash in the pockets of those who locked in those incredibly low rates. But like a captivating dream that fades upon waking, those ultra-low rates have receded, replaced by a more sobering reality of rising interest rates. The Federal Reserve, tasked with taming the beast of inflation, has embarked on a path of interest rate hikes, pushing mortgage rates higher and leaving many wondering if those sub-3% days are gone for good. While gazing into the crystal ball of future mortgage rates is a fool's errand, we can examine the factors at play, analyze historical trends, and explore potential scenarios to gain a more informed perspective on the likelihood of those sub-3% rates making a comeback. The historical context. Lessons from the past. To understand the potential trajectory of mortgage rates, it's helpful to take a stroll down memory lane and revisit the historical landscape of interest rates. Mortgage rates, like fashion trends, have a cyclical nature, often reflecting broader economic conditions, government policies, and market sentiment. Cast your mind back to the early 1980s, a time of soaring inflation when mortgage rates skyrocketed to dizzying heights, peaking at over 18%. Imagine the sticker shock for homebuyers at that time. Those double-digit rates made homeownership a distant dream for many and put immense pressure on those who had mortgages. Since those dark days of double-digit interest rates, we've witnessed a gradual but significant decline in mortgage rates, driven by factors such as falling inflation, technological advancements in lending, and increased competition in the mortgage market. For decades, the trend line for mortgage rates has generally been downwards, with occasional blips along the way. However, it's crucial to remember that past performance is not necessarily indicative of future results. While the long-term trend for mortgage rates has been downwards, there's no guarantee that this trend will continue indefinitely. Economic conditions can change, policy priorities can shift, and unforeseen events can throw a wrench into even the most well-reasoned forecasts. The inflation conundrum, a key piece of the puzzle. In the intricate puzzle of mortgage rate forecasting, inflation stands out as a particularly enigmatic piece. Its unpredictable nature and potential to erode purchasing power make it a focal point for economists, policymakers, and consumers alike. Understanding inflation's trajectory is crucial for gauging the likelihood of those sub-3% mortgage rates returning. Inflation, like a mischievous sprite, can be difficult to pin down. Is the recent surge in inflation a temporary blip, fueled by supply chain snarls and pent-up consumer demand in the wake of the pandemic? Or is it a more persistent threat, deeply embedded in the economy and poised to linger for years to come? If inflation proves to be transitory, as some experts predict, it could gradually moderate, allowing the Federal Reserve to ease its foot off the interest rate gas pedal. This scenario could create a more favorable environment for mortgage rates to potentially stabilize or even decline slightly, though a return to sub-3% levels might remain a distant hope. However, if inflation proves more stubborn, clinging to the economy like a tenacious vine, the Federal Reserve might be forced to take a more aggressive approach to taming it, continuing its path of interest rate hikes to cool down economic activity and bring inflation under control. This scenario could push mortgage rates even higher, making those sub-3% rates a distant memory. The Fed's balancing act: growth versus stability. At the helm of the U.S. economy stands the Federal Reserve, wielding its powerful monetary policy tools to steer the ship between the often competing goals of promoting economic growth and maintaining price stability. The Fed's balancing act has profound implications for mortgage rates, making its every move a subject of intense scrutiny. Like a skilled tightrope walker, the Fed must carefully calibrate its actions, knowing that a misstep in either direction could have significant consequences. Raising interest rates too quickly or aggressively could stifle economic growth, potentially tipping the economy into a recession. On the other hand, delaying interest rate hikes or keeping rates too low for too long could allow inflation to spiral out of control, eroding purchasing power and undermining economic stability. The Fed's current stance suggests a heightened concern about inflation. After years of accommodative monetary policy, characterized by low interest rates and bond purchases, the Fed has shifted its focus towards reining in inflation, embarking on a path of interest rate hikes and signaling its intention to reduce its bond holdings. This shift in the Fed's stance has put upward pressure on mortgage rates, and the central bank's future actions will continue to play a pivotal role in shaping the trajectory of borrowing costs. If the Fed maintains a hawkish stance, prioritizing the fight against inflation over concerns about economic growth, it could lead to further interest rate hikes, potentially keeping mortgage rates elevated for the foreseeable future. While the U.S. economy often commands the spotlight, it's essential to remember that it doesn't exist in isolation. It's part of a complex and interconnected global ecosystem, where economic events in one part of the world can reverberate outwards, influencing financial markets, interest rates, and even the price of a cup of coffee half a world away. The global economic outlook, much like the weather, can be fickle and prone to unexpected shifts. Geopolitical events, such as the war in Ukraine or rising tensions between the US and China, can create shockwaves that ripple through the global economy, leading to uncertainty, volatility, and potentially influencing the direction of mortgage rates in the US. For example, a slowdown in economic growth in China, a major engine of global demand, could have ripple effects throughout the world, potentially leading to lower demand for US exports, reduced corporate profits, and slower economic growth in the US. This scenario could prompt the Federal Reserve to be more cautious in raising interest rates, potentially putting downward pressure on mortgage rates. Conversely, a surge in economic growth in Europe or Japan could boost global demand, leading to higher commodity prices, increased inflation, and potentially prompting central banks around the world, including the Federal Reserve, to raise interest rates more aggressively to keep their economies from overheating. This scenario could put upward pressure on mortgage rates in the U.S., even if domestic economic conditions remain relatively stable. Section 6. The housing market equation: supply, demand, and affordability. The dynamics within the U.S. housing market shape mortgage rates. Supply, demand, and affordability challenges determine borrowing costs. A chronic shortage of housing inventory persists. Rising construction costs and labor shortages constrain new home building. This imbalance raises home prices and mortgage rates. Affordability challenges complicate the housing market equation. Less attainable homes might ease pressure on prices and rates. Demographic trends and economic conditions influence housing demand. Strong demand could still push prices and rates higher. Section 7. The potential scenarios: mapping out the possibilities. Predicting mortgage rates is tough, but we can explore scenarios to understand potential outcomes. Scenario 1. The soft landing. Inflation moderates, the Fed avoids recession, and mortgage rates stabilize. Scenario 2. The bumpy ride. Persistent inflation forces aggressive rate hikes, risking recession. Scenario 3. The unforeseen disruption. Global shocks could unpredictably impact mortgage rates. The prospect of potentially lower mortgage rates in the future can be a tempting siren song for prospective homebuyers, leading some to delay their home purchase plans in the hopes of snagging a better deal down the road. However, this strategy of trying to time the market is fraught with risk and often leads to more regret than reward. The reality is that predicting the future direction of mortgage rates with any degree of accuracy is impossible. Even seasoned economists and market analysts with access to sophisticated models and troves of data often get their forecasts wrong. The market, as they say, is driven by both rational actors and irrational exuberance, making its movements notoriously difficult to predict. While it might be tempting to delay your home purchase in the hopes of securing a lower mortgage rate in the future, it's essential to weigh this potential benefit against the costs of waiting. Rents continue to rise in many parts of the country, eating into potential savings that could be used for a down payment. Additionally, delaying your home purchase means missing out on the benefits of homeownership, such as building equity, customizing your living space, and putting down roots in a community. Instead of trying to time the market, focus on timing your life. Consider your personal circumstances, financial situation, and long-term goals. If you're financially prepared to buy a home, you found a place where you can see yourself living for several years, and the monthly payments fit comfortably within your budget, then waiting for a potentially lower mortgage rate might not be worth the risk. As we've journeyed through the labyrinthine world of mortgage rate forecasting, one recurring theme has been the lack of a unified consensus among experts. Economists might disagree about the trajectory of inflation, financial advisors might offer varying risk assessments, and real estate professionals might observe different trends in their local markets. This cacophony of conflicting opinions can be both bewildering and liberating. On the one hand, it underscores the inherent uncertainty of predicting the future, especially in a field as complex and dynamic as finance. It's a humbling reminder that no one, regardless of their credentials or experience, has a crystal ball that can predict the future with absolute certainty. On the other hand, this diversity of perspectives can also be a valuable asset for informed decision-making. Instead of searching for a single right answer, which likely doesn't exist, embrace the uncertainty and use it as an opportunity to ask questions, challenge assumptions, and consider a range of possibilities. Seek out diverse perspectives, gather information from credible sources, and don't be afraid to think critically about the information you encounter. The more informed you are, the better equipped you'll be to navigate the ever-changing world of mortgage rates and make decisions that align with your individual circumstances and risk tolerance. So, where does this leave us in our quest to answer the million-dollar question? Will mortgage rates ever return to those enticingly low sub-3% levels? The honest answer, as unsatisfying as it might seem, is that no one knows for sure. The future of mortgage rates, much like the economy itself, is a complex and ever-changing landscape, influenced by a multitude of factors that are difficult to predict with certainty. However, this inherent uncertainty doesn't render us powerless. While we can't control the direction of the economy or the decisions of the Federal Reserve, we can empower ourselves with knowledge, understanding, and a healthy dose of perspective. By staying informed about economic trends, understanding the factors that influence mortgage rates, and consulting with trusted financial professionals, we can make more informed decisions that align with our individual circumstances, financial goals, and risk tolerance. Remember, the most important decision isn't necessarily about securing the absolute lowest mortgage rate possible. It's about finding a mortgage that fits comfortably within your budget, allows you to achieve your financial goals, and provides peace of mind knowing that you've made a sound financial decision. As we draw the curtains on our deep dive into the world of mortgage rates, it's time to address the elephant in the room, or rather, the sub-3% elephant. It's only natural to yearn for those record-low rates that graced us, however briefly, during the turbulent early days of the pandemic. The allure of such incredibly affordable borrowing costs is hard to resist, like a siren song whispering promises of financial freedom and attainable homeownership. But just as a mirage shimmers deceptively in the desert heat, promising relief that's ultimately illusory, those sub-3% mortgage rates might remain tantalizingly out of reach for the foreseeable future. While we can't entirely rule out the possibility of those rates making a surprise comeback, clinging to that hope could lead to disappointment, missed opportunities, and a sense of paralysis when it comes to making important financial decisions. The economic realities we face today paint a different picture than the unique circumstances that allowed for those ultra-low rates in 2020 and early 2021. Inflation, once a dormant giant, has awakened with a vengeance, forcing central banks around the world, including the Federal Reserve, to tighten monetary policy, raising interest rates to cool down economic activity and bring inflation under control. The housing market, too, has undergone a significant transformation. Years of underbuilding, coupled with surging demand fueled by those very same low mortgage rates, have created a chronic shortage of housing inventory, pushing home prices to record highs and exacerbating affordability challenges for many aspiring homeowners. Section 2. Navigating the Rate Maze. Practical tips for homebuyers and owners. Navigating mortgage rates can feel like a maze with twists and turns. But with the right tools, you can emerge victorious, whether you're a first-time home buyer or refinancing. Don't let rate fluctuations paralyze you. Waiting for the lowest rate could mean missing out on opportunities. Focus on financial preparedness. Save for a down payment, improve your credit score, and get pre-approved. Consider all costs, not just the interest rate. Work with experienced professionals. A real estate agent and a reputable lender can guide you. For current homeowners, review your mortgage terms. Are you happy with your interest rate and payments? Refinancing might lower costs or tap into equity. Compare offers from multiple lenders. Rates and terms vary, so ensure you're getting the best deal. Consider your long-term financial goals. Section 3. The power of perspective, shifting your mindset. In the grand scheme of things, mortgage rates are just one piece of the intricate puzzle that makes up our financial lives. While it's easy to get caught up in the day-to-day fluctuations of interest rates, obsessing over every basis point move, it's important to step back and gain a broader perspective. Shifting our mindset from a place of fear and scarcity to one of empowerment and abundance can make a world of difference in how we approach our financial decisions. Instead of viewing mortgage rates as an insurmountable obstacle, reframe them as an opportunity to assess your financial priorities, clarify your long-term goals, and make choices that align with your values. Are you willing to make certain lifestyle adjustments, such as downsizing your living space or delaying a major purchase to achieve your dream of homeownership? Are there creative financing options, such as an adjustable rate mortgage or a government-backed loan, that might better suit your circumstances? Remember, financial well-being is not solely determined by the number on your mortgage statement. It's about creating a life of purpose, meaning, and fulfillment, where financial security provides a solid foundation but doesn't dictate your every move. Embrace a mindset of abundance, focusing on the opportunities that exist rather than dwelling on the perceived limitations. Explore alternative paths, seek out creative solutions, and remember that your financial journey is uniquely yours to define. Section 4. Beyond the numbers, the true value of home. As we conclude our exploration of the ever-evolving world of mortgage rates, it's essential to remember that a home is much more than just a financial asset. It's a sanctuary, a gathering place, a reflection of our personalities and aspirations. It's where we create memories, nurture relationships, and build a sense of belonging. The true value of home transcends the dollars and cents listed on a mortgage statement. It's found in the laughter of children playing in the backyard, the aroma of a home-cooked meal shared with loved ones, and the comfort of curling up with a good book in a cozy nook. While financial considerations are undoubtedly important when making decisions about homeownership, it's equally important to consider the intangible benefits that a home provides. A home is an investment in your well-being, your relationships, and your overall quality of life. So as you navigate the world of mortgage rates, don't lose sight of the bigger picture. Remember the reasons why you're seeking homeownership in the first place. Let those aspirations guide your decisions, and trust that the right home will find you when the time is right. Section 5. The final word, embracing uncertainty, embracing opportunity. The world of finance, much like life itself, is a tapestry woven with threads of uncertainty. We can gather information, analyze trends, and seek expert advice, but ultimately the future remains shrouded in a veil of mystery. And that's okay. In fact, it's this very uncertainty that creates the space for opportunity, innovation, and growth. Instead of fearing the unknown, embrace it. View it as a blank canvas upon which you can paint your own financial masterpiece. Approach your financial decisions with a spirit of curiosity, a willingness to adapt, and a belief in your ability to navigate whatever challenges and triumphs lie ahead. Remember, you are not alone on this journey. Surround yourself with trusted advisors, seek out mentors, and learn from the experiences of others. The more you learn, the more confident you'll become in your ability to make sound financial decisions that support your dreams and aspirations. The path to financial well-being is rarely linear. There will be detours, roadblocks, and unexpected turns along the way. But with each challenge overcome, you'll gain valuable experience, resilience, and a deeper understanding of your own financial strength. So, as you embark on your own financial adventures, remember to embrace the uncertainty, seize the opportunities that present themselves, and never stop learning and growing. The future of finance, much like the future itself, is yours to shape.